You're at a party, or a barbecue, or a family dinner, and someone starts talking about money. It's always that guy, the one with the loud voice and the confident opinions. He's telling everyone about his latest play. The crypto that just went parabolic. The stock that doubled in a month. The options trade that turned $1,000 into $10,000 overnight. He's showing his phone. People are gathered around. They're nodding. They're impressed. They're asking questions. You look at your own portfolio. You've got some index funds. Some boring dividend stocks. Maybe a REIT or two. Your returns this year? Solid. Respectable. Boring. About 8%. And you feel it. That little twinge. That whisper in your ear. Maybe I'm doing this wrong. Maybe I should be more like him. Maybe I'm missing out. Here's the thing. I've been there. We've all been there. The fear of missing out is one of the most powerful forces in investing. It makes smart people do dumb things. It makes patient people become gamblers. It makes boring portfolios suddenly feel inadequate. But here's what most people don't realize. That guy at the party? The one with the 100% gains? He's not going to tell you about the 80% loss that came after. He's not going to tell you about the 3 trades that wiped out all his gains. He's not going to tell you that his genius strategy is actually just gambling with extra steps. In the real world, the people who get rich slowly are the ones who stay rich. The ones who chase genius returns? They're the ones who start over. Again and again. This is the gray man philosophy. In Spycraft, the gray man is the one who blends in. The one nobody notices. The one who doesn't attract attention. In investing, the gray man is the one who blends in with average returns. Not flashy, not exciting, but also not dead. And over time, blending in makes you richer than standing out. Every single time. Hi, what's up? I spend way too much time thinking about why we're drawn to the investing equivalent of bright, shiny explosions that destroy our wealth. If you're someone who's ever felt inadequate looking at your boring portfolio while watching someone else brag about their genius gains, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Most people think investing is about having a lot of money. The truth? It's about what you keep. And the fastest way to keep nothing is to chase everything. I'm building a community at the Frugal Investor newsletter where we strip away the hype and focus on high-impact, low-cost wealth building. Get your copy, The 15-Day Blueprint for Wealth and Financial Autonomy, and join a group of like-minded investors who prioritize long-term gains over short-term trends. Link is in the description. Let's start with the metaphor, because it's powerful. In intelligence and military circles, the gray man concept is simple. You want to be invisible. You don't want to attract attention. You dress like everyone else. You act like everyone else. You blend into the background. The people who stand out. They get noticed. They get targeted. They don't last. Investing is the same. The bright investors, the ones with the huge wins, the bold predictions, the constant action, they attract attention. From the media, from regulators, from scammers, from their own egos. They make huge bets. They win big. They lose bigger. And eventually, they get wiped out. The gray man investors? They're boring. They buy index funds. They hold real estate. They collect dividends. They don't make headlines. They don't brag at parties. They just slowly get rich. And here's the thing. Slow and steady doesn't just win the race. It wins by so much that the hare can't even see the finish line. Let's do the math, because the numbers are undeniable. Let's say you have 2 investors, Flash and Gray. Flash chases genius returns. Some years he's up 100%. Some years he's down 50%. It averages out to maybe 10% a year, but with massive volatility. Gray blends in. He buys the S&P 500 and holds. He averages 9 to 10% a year with much less volatility. Now, let's look at what actually happens over time. Scenario A. The volatility trap. Year 1. Flash is up 100%. $10,000 becomes $20,000. He's a genius. Year 2. Flash is down 50%. $20,000 becomes $10,000. He's back where he started. Gray is up 10% each year. $10,000 becomes $11,000, then $12,100. After 2 years, Flash has $10,000. Gray has $12,100. Gray wins. Scenario B. The long term. Let's extend it. Flash has some good years and some bad years. His average return is 10%, but the sequence matters. Year 1. Plus 100%. $10,000 to 20K. Year 2. Minus 50%. 20K to 10K. Year 3. Plus 100%. 10K to 20K. Year 4. Minus 50%. 20K to $10,000. After 4 years, Flash is back where he started. Zero growth. Gray is up 10% each year. Year 1. $11,000 year 2. $12,100 year 3. $13,310 year 4. $14,641. Gray is up 46% while Flash is flat. This is the volatility tax. The more volatile your returns, the more you need to earn just to break even. A 50% loss requires a 100% gain to recover. That's a brutal math problem. The statistics of Genius now. Let's look at the data on Genius investors. Because this isn't just hypothetical. According to the SPIVA scorecard from S&P Global, over 90% of active fund managers fail to beat their benchmark over a 15-year period. These are professionals. People with MBAs, research teams, and decades of experience. And they can't consistently outperform. What makes you think you can? Another study by Dalbar found that the average equity fund investor earned about 5% annually over the last 20 years, while the S&P 500 returned about 9.5%. That's a 4% gap. Why? Because investors chase performance. They buy after big gains and sell after losses. They turn Genius returns into average returns, and average returns into losses. And here's a statistic that will blow your mind. According to a study by the University of California, the top 1% of day traders, the actual geniuses, barely beat the market after fees. And they're the exception. The other 99% lose money. The math is clear. Trying to be a genius is a losing game. The psychology of chasing now. Let's talk about the brain. Because this is where the trap is set. There's a concept in behavioral finance called recency bias. We give too much weight to recent events. If someone just had a huge gain, we assume they're smart. If a stock just went up, we assume it will keep going up. This is why we chase winners. This is why we buy at the top. This is why we think the guy at the party is a genius, even though he's probably just lucky. There's also overconfidence bias. After a few wins, we think we're invincible. We take bigger risks. We make bigger bets. We ignore the possibility of loss. And then the loss comes. And it wipes out everything. I remember talking to a guy in 2021. He'd made a fortune on crypto. He was up 2,000%. He was quitting his job. He was buying a sports car. He was a genius. I asked him, "What's your exit strategy? How do you know when to sell?" He laughed. "Sell? This is going to the moon. I'm never selling." 6 months later, his portfolio was down 90%. He was back at work. The car was repossessed. He wasn't a genius anymore. He was just another gambler who got lucky and then got unlucky. The story of two investors. Let me tell you a story about two real people. We'll call them Alex and Ben. Alex is a chaser. He's always looking for the next big thing. He bought crypto in 2017 at the top, sold at the bottom. Bought meme stocks in 2021, sold at the bottom. Bought AI stocks in 2023, sold at the bottom. He's made some money on the way up, but lost it all on the way down. After 10 years, his portfolio is about where he started. Ben is a gray man. He buys an S&P 500 index fund every month. He also owns a right for diversification and a small allocation to bonds. He doesn't check prices. He doesn't read predictions. He just buys and holds. After 10 years, Ben's portfolio has grown by an average of 9% per year. His $10,000 initial investment is now over $23,000. His monthly contributions have grown even more. He has over $200,000 saved. Alex has maybe $30,000. Ben has over $200,000. Same time period, same starting point, different philosophy. The difference wasn't intelligence. It wasn't access to information. It was the willingness to be boring. The gray man portfolio. So what does a gray man portfolio actually look like? Let's build one. Core. 60 to 80% total stock market index fund. This is the foundation. VTI, VU, or similar. You own the entire US stock market. You capture the average return of American capitalism. Over time, that average is about 9 to 10%. Not flashy, but reliable. Satellite. 10 to 20% international stock index fund. Diversification across borders. VTIX, VXUS, or similar. International stocks often underperform the US, but they also provide diversification. When the US is down, they might be up. Smooths out the ride. Real estate, 10 to 20% right index fund. VNQ or similar. Real estate behaves differently than stocks. Provides income, provides diversification. Historically has returns similar to stocks but with different timing. Bonds, 0 to 20% depending on age. For younger investors, maybe skip bonds. For those closer to retirement, add a bond fund like BND. Provides stability, reduces volatility. Cash, emergency fund and high-yield savings. 3 to 6 months of expenses. Boring, safe, there when you need it. That's it. 4 funds. Maybe 5. No individual stocks. No crypto. No options. No leverage. Just boring, diversified, low-cost index funds. This portfolio will return about 8 to 10% over the long term. It will never be the best performing portfolio in any given year. But it will never be the worst either. It will just grow. Quietly, consistently, invisibly. The statistics of boring. Let's look at the historical data on this kind of portfolio. According to Vanguard, a 60/40 portfolio, 60% stocks, 40% bonds, has returned about 8.6% annually over the last 90 years. A 100% stock portfolio has returned about 10% annually. Now, compare that to the average individual investor, who according to Dalbar earns about 5% annually. The boring portfolio beats the active investor by 3 to 5% per year. Over 30 years, that's the difference between $100,000 and $400,000. Between retiring at 65 and retiring at 55. Boring wins. The surprising insight. Volatility is the enemy. This is where it gets really interesting. The biggest threat to your wealth isn't low returns. It's volatility. When your portfolio goes up and down wildly, you're tempted to do something stupid. You're tempted to sell when it's down. You're tempted to buy when it's up. You're tempted to chase the next thing. The Grayman portfolio smooths out the ride. It doesn't have huge ups, so you don't get overconfident. It doesn't have huge downs, so you don't panic. You just stay the course. And staying the course is the most important thing you can do. Think about it. If you'd invested $10,000 in the S&P 500 in 1980 and done nothing, you'd have over $800,000 today. That's an 8,000% return. From doing absolutely nothing. If you'd tried to time the market, if you'd chased the hot stocks, if you tried to be a genius, you'd almost certainly have less. Much less. The best investors aren't the smartest. They're the most boring. The actionable steps. How to be a gray man. Okay, so you're convinced. You want to be boring. You want to blend in. How do you actually do it? Step 1. Automate everything. Set up automatic investments into your boring funds. Every month, on the same day, money moves from your bank to your brokerage to your index funds. You don't think about it. You don't decide. You just do it. This removes emotion from the equation. You're not investing when you feel like it. You're investing because it's Tuesday. Step 2. Stop checking. Uninstall the apps. Turn off the notifications. Check your portfolio once a quarter, maybe once a year. The less you look, the less you'll be tempted to do something stupid. Step 3. Ignore the noise. Don't read financial news. Don't watch CNBC. Don't follow stock tips on social media. None of it matters. The market will do what it does, and your boring portfolio will just sit there, growing quietly. Step 4. Rebalance once a year. Once a year, look at your portfolio. If one asset class has grown too much, sell a little and buy the others. This forces you to sell high and buy low automatically. It's the only active thing you do. Step 5. Define your benchmark. Your benchmark isn't the guy at the party. It's not the crypto millionaire. It's the market. If you're matching the market, you're doing great. If you're slightly behind, who cares? Over time, you'll win. Addressing the objections now, you might be thinking, James, this is so boring. I want excitement. I want to feel alive. I get it. Excitement is fun. But here's the thing. You can get excitement elsewhere. Go skydiving. Go travel. Go start a business. But don't look for excitement in your retirement account. Your retirement account should be the most boring thing in your life. It should put you to sleep. Because if it's exciting, that means it's volatile. And volatility is the enemy. You might also think, but what about the people who actually did get rich on crypto? What about the ones who hit it big? Sure, they exist. But for every one of them, there are 1,000 who lost everything. You're not hearing about them. You're not seeing their posts. They're the silent majority. The lottery has winners too. That doesn't make buying a ticket a good investment. The reframe. From star to gray man, the final shift is identity. You have to stop wanting to be the star and start being okay with being the gray man. The star gets attention. The star gets applause. The star also gets targeted, criticized, and eventually forgotten. The gray man gets results. Quietly, consistently, without drama. In investing, being the gray man means you're not trying to beat the market. You're not trying to impress anyone. You're just trying to build wealth. Slowly, surely, invisibly. And over time, that invisibility becomes the most visible thing about you. Because while everyone else is starting over, you're retiring early. While everyone else is stressing about the next crash, you're sleeping peacefully. While everyone else is chasing the next thing, you've already arrived. Look, I'm not saying you should never take risks. I'm not saying you should never have fun with a small portion of your portfolio. If you want to set aside 5% for fun money, go for it. Gamble, chase, see what happens. But the other 95%? That should be boring. That should be gray. That should be the foundation that lets you sleep at night. The people who win in investing aren't the geniuses. They're the ones who show up, consistently, year after year, and do the boring thing. They buy index funds. They hold. They wait. And eventually, they get rich. Not rich quick. Rich slow. Rich sure. Rich forever. That's the gray man way. And it works. I really hope this video brought you some value today. If it did, comment more down below. I'm reading through those to decide what topics to cover next, so definitely let me know if you want more of this. Stop chasing genius. Start blending in. And I'll see you in the next one.